Okay, so Rob is not with us yet, but I'll work hard during the presentation to make sure he's here at least by the end of it. No promise, but I think it's time for us to start. And I want to start by welcoming everybody who joined us for this new instance of the CEPR Virtual IO Seminar series. And we are delighted today to have Giulia Brancaccio as our speaker. And she'll present the paper titled Search Frictions and Product Design in the Municipal Bond Market, joined with Karan Khan. So thank you, Giulia, for being with us. And Giulia will present the paper for about 45 minutes. And then hopefully we'll have a 5-minute discussion by Rob Clark, who should be joining us momentarily. And then whatever leftover time we have will be open discussion from the audience. Now, if you want to ask a question, I think Giulia is going to pose at some point during the presentation. During the 45 minutes, we ask you to only ask clarifying questions. And also, there is the option to hit the chat where Karam, Giulia's co-author, is going to be there. And I think with that, the last thing I want to remind you is probably should be more when you join the session is that this session has been recorded and a native version of it will be at some point be posted on the CEPR website. So if you don't want to show up on the recording, act accordingly. Okay, so with that, I think Giulia, the floor is yours and take it away, and thank you very much again.
All right, so thank you very much to the organizer for including this paper in the program, and Rob, when he arrives, thank to him for agreeing to discuss the paper. I'm really excited to hear what you think about to hear your comments about this, and and Karam will be managing the chat if you have pressing questions. So let me get started. So at the core of the paper, there is a very simple observation, which is that in a large number of different markets, when a consumer has to pick a product, they face a huge variety of extremely customized alternatives. And on the one hand, we all agree about the benefits of these product customization. But at the same time, if you ever happen to shop for insurance, try to sign up for a credit card or get a mortgage, you'll have to agree with me that shopping among these extremely customized alternatives is difficult. It's difficult to compare alternatives, and it's difficult to find the option which is best suited for your needs. Now, how this trade-off is solved is really determined by the incentives of the producers when they sit down and decide the attributes of the products that they actually want to include, the attribute that will actually be offered. And in this paper, we focus exactly on the producer's incentive. And in particular, we ask whether it's possible and when it happens that the producer may have an incentive to offer these extremely customized products with the intent of making search harder for consumer or complicating the search process. And the setup will be that of the US municipal bond markets. So what are municipal bonds? These are securities issued by local governments in the US to finance investment in infrastructure. So if you're a city and you want to build a school, you're going to issue municipal bonds. And in fact, 95% of the investment in infrastructure in the US is financed by issuing municipal bond, which makes this market all the more relevant, especially given the dire state of infrastructure in the US. Now, I'm going to talk a lot about bond attributes. What do I mean by that? When at its simplest, a municipal bonds need to specify a maturity, which is a date when the government needs to return the money to investor, an interest rate, which is paid every 6 months, and the face value of the bond, the total amount of this bond. However, municipal bonds are never this simple. And in fact, at issuance, at origination, they are usually packed with a large number of special attributes. Just to give you an example, here we have a bond issued by the city of Alexandria next to DC to finance the building of a school. And the offering statement, which is basically the bond contract that specifies the bond attributes, is more than 100 pages long and introduces a number of special attributes like optional redemption, partial collateral, weird way to set the interest rates. Now, understanding exactly how each one of these special attributes work, it's not really necessary for the purpose of the paper, but I want to walk you at least through one of them to make sure we all understand, we are all on the same page. So let me tell you what is optional redemption. This is a clause in the bond that allows the issuing government to call back the debt either in full or in part before maturity under special circumstances at a price which is either determined, in advance, or it's anchored to different indexes. And if you think about what this clause is doing, well, it's basically introducing some flexibility, valuable flexibility for the government, because, if the government has some extra cash, they can use it to, pay back some of their debt before maturity. However, it also introduces a risk for investors, because if the debt is actually called back, you cannot, you are not going to receive future interest payments. And it's a risk which is difficult to price and assess, because you need to think about the likelihood that debt will be called back, the price when that happens, the price that you received from the government when that happens, and so on and so forth. And so pretty much like this example, you can think of these special attributes as clauses in the bond contracts that introduce some flexibility, which moves some risk either from the government to investor or from investor to the governments. And by doing that, they introduce a risk which is, usually difficult to price and assess. And I want to say that the SEC repeatedly emphasized how the prevalence of these, special attributes or extremely customized bonds really complicate trading for investors. And in fact, they advocated in favor of reducing the number of these extremely customized bonds in order to reduce the trading frictions that investors face. So how are these bonds determined? Well, they are determined, bond attributes determined, they are determined at origination through negotiation between the government official and an underwriter. So the underwriter will be the key character in our paper. So let me spend 1 minute telling you about what they do. So this underwriter is a financial institution, and they are in charge of the initial marketing of the bond, which means that they meet with the government official, they help them design the bond, and then they buy the bond from the government and they sell it to investors. Now, the key, however, that a key aspect of this underwriting business is that the underwriter. So even though this is basically the basic duty of the underwriter, they tend to remain active in the market of the bond they issued long after origination, and in particular after origination, the bond, the underwriter competes with other financial institutions to intermediate trade, so to attract orders from investors and buy and sell the bond among to and from investors. And not only the underwriter is active as in this intermediation market, but importantly, they tend to maintain a dominant market share in this market. And anecdotally, the reason is that the underwriter knows the market for these bonds. So if you're an investor and you want to sell large quantities of these bonds, the easiest way to do that is to go to the underwriter, because they know the market, they know who bought the bond in the past, they know who may want to, may want more, they know who may want to sell it. And so basically in this paper, we ask whether this dual role for the underwriter, who both design the bond and acts as an intermediary when the bond is traded, distorts the extent of customization in this market. If so, what are the welfare implications and how can the government intervene? As an example, is it a good idea to mandate standardization? And I want to emphasize that, these questions, while they are essential are very relevant for the market for municipal bonds, they resonate beyond it. And in fact, in a number of different markets, from insurance to annuities, mortgages, we have seen the proliferation of these extremely complex, extremely customized bonds, products, which in turn has sparked a debate over the benefit of standardization. And, we are going to speak, this paper is going to try also to speak about to this debate. So how we are going to do all of this? So we are going to start exploiting changes in ethics regulation at the state and local level in order to build an instrumental variable framework that will allow us to measure the impact of, the impact of customization. Then we are going to use build and estimate a model for bond design and trade, and we're going to use it to think about counterfactual policies. As an example, is standardization a good idea? And so what do we find? Let me start with the instrumental variable framework. We're going to, first of all, provide evidence of obfuscation. We're going to argue that the underwriter has an incentive from issuing these extremely complicated, extremely customized bonds, because it helps them when they act as an intermediary for the bond. It allows them to increase their profit there. And we are going to find that, that this customization does indeed increases the trading friction that investors face by, as an example, lowering the trading, how much traded there is and increasing the intermediation spread. Now, the question becomes, so these two facts point to a distortion in the level of customization in this market. And what we want to do now is to measure this distortion and quantify its welfare consequences. So to do that, we are going to estimate a model of bond design and trading. In this model, we are going to be very careful and flexible in general. And in particular, we are going to allow the government to value the flexibility afforded by these special attributes. And we are going to find that indeed customization increases the search friction that investors face, gives the underwriter a competitive advantage vis-a-vis other financial institutions when it comes to search. And as consistent with the story I told you before, it lowers basically the government values the flexibility afforded by these special attributes, at least when they are there in moderation. And so, so when we, given this result, it's no surprise that eliminating the underwriters using our model, we find that eliminating the underwriter's incentive to issue these over-customized bonds does indeed lower customization, lower the search frictions in this market, and hurts not only the underwriter itself, but all the intermediaries that, in a sense, in this market benefit from the extra search frictions created by this bond, by these special attributes, benefiting basically investors and the government. So, given all of this, it would seem like standardization may be a good idea, but that's actually not the message of the paper. And the reason is that while the underwriter has incentive to over-customize, there is some level of customization that is beneficial even for the government. And in fact, this desire of flexibility from the government means that if you impose standardization, the government itself is going to be hurt. So I'm not going to have a lot of time for the related literature. So why don't I pause here for question and otherwise I'm going to go home, move on.
Giulia, I got here a little late. I apologize. The example you gave of the municipality being able to call the bond early. My immediate reaction is that's a call option, and the issuer is going to pay, the example you gave, hey, if they wanted to buy the bond back, they could do it at market rates at any time. What this clause does is give them a call option, and they're going to pay for it up front. Shouldn't that be part of the story, that you expect the municipality to pay for whatever options are going to favor it? You would, if there are things that favor the investor, you would expect them to pay for options that favor them.
So I'm not sure I exactly follow, but basically, so let me answer and then you tell me if it answers your question. So basically, we are going to allow both the government and the investor's valuation to depend on these special attributes. And what we want to capture is exactly the fact that, it could be that investors really like the special attributes. It could be that the government really likes the flexibility afforded by them. And we are going to be as flexible as possible exactly because we want to, be able to capture the fact that, either parties would like them. That's, yeah.
So in some sense, in the first instance, you expect the value of the clauses to be priced into
Correct.
the bond, but then if there's also obfuscation, then rational investors, rational governments ought to take that this is the obfuscation is going to lead to wider margins, less trading, and that would be taken into account by forward-looking parties.
Correct.
That's the basic story?
Yes, so I think so. Yeah, if I understand correctly, yeah. Okay.
Can I ask a question? Is there a space for learning through this? I miss the word. Through these special contracts. Because the intermediary may learn something about potential buyers, the appetite for taste for.
So we are going to allow, we are not going to model explicitly learning, but we are going to allow for network effects in search, which captures exactly that, which basically tells you that, it's easy to sell the bond to someone who already has it because you don't have to explain them again, right? And so, if you have a larger network client network, which means you sold the bond to more investors, then it's going to be easier for you to sell them. So does that answer your question?
Yeah. One other question. Is there competition among underwriters?
So yes and no. So we are not going to think about that. So we are going to assume that basically the government has only one underwriter that they face. And the reason is that these underwriting markets tend to be very concentrated. So relationships are very persistent. So, the underwriter, the government, issuing government tend to deal with the same underwriter over and over again, right? Which in a sense creates a form of market power. And then even at the county, like if you look at the market at the county level, there are not that many underwriters out there. And so we are going to assume that this is a monopolistic market where basically a government deals with the same, with a given underwriter.
Yeah, I wasn't questioning whether the underwriter market was concentrated. The question is, would it make a difference if there was competition among underwriters?
Yes, it would. And if there was competition, also the way I think about it is that if there was competition in the underwriting market, then a standard like a Chicago critique would apply. And so the way I think about it is that you have an underwriter, they have market power, and they leverage this market power to increase their market share, increase their market power in the trading market, where instead they have to compete with other dealers. Okay, I'm going to move on. So let me tell you, more about municipal bonds that you ever wanted to know. So this is, a large market, $4 trillion of municipal bond outstanding, half of the corporate bond market. There are 1.5 million different issues, and these are issued by states, cities, counties, school districts, special districts like waste management districts. So think of very small local governments. These bonds tend to be very safe. Defaults, in fact, are very, very rare for a municipal bond, and the corporate bonds in exactly the same risk rating. The municipal bond has default rates which are 20 to 50 times lower than corporate bonds. And the key detail of this market is that the returns from municipal bonds are exempt from federal and usually local taxation, which means that if you are a retail investor, which means that all of these bonds end up being owned by retail investors, mostly, maybe surprisingly, mostly directly, and in part through ETF or mutual funds. So what happens if one of these investors want to buy or sell this bond? Well, there is a secondary market that provides liquidity. There is no centralized marketplace for municipal bonds. Transactions happen in a decentralized way through dealers. And again, maybe surprisingly, there are no trading platform, no electronic trading. Most trading is done through, via telephone or in person. And so what do these dealers do? Well, they have salespeople that basically get to know their client, their financial goals and needs, and they look for securities that match the needs and the financial needs of their client, call them and offer these trades. And another important aspect of their job is that they have to explain the bond to these to their investors. And so if you read, articles or industry publication, there are these, hours-long meeting with the investor where they basically walk them through all the special attributes of the bond and how they correlate with the financial needs of the investors. Why this is necessary? Again, as I mentioned, these bonds are very customized. In fact, for every issue, which is all the money issued in a given occasion, there are 6 to 7 special provisions, which means that each bond has between 1 or 2 special provisions included. So again, as I mentioned before, the special attributes are determined through negotiation between the government and the underwriter. And I want to emphasize that an important component of this relationship is the potential for conflict of interest. In fact, different regulation try to limit the conflict of interest coming from gift, which are not allowed, campaign contribution, which are again forbidden, and most importantly for us, employment of opportunity. So what I mean by that? So let me walk you through the career path of this Kimberly Feeney, which is kind of representative of the problem here. So she started her career as a public servant as a CFO of county. Then she moved on, worked for the district, Forest Preserve District, and in both. So I should say that as CFO, she was directly in charge of designing and issuing municipal bonds. And then she decided it was enough, and she was hired by Bank of America Merrill Lynch, exactly as the government client manager in charge of these issuances. Now, this type of career path definitely create the appearance of conflict of interest, probably also the substance of conflict of interest. And because of that, most states have some sort of revolving door regulation that prevent government officials from working with, with businesses with whom they had to deal with, while they were in office. So over our sample period, which started in 2009, all but 15 states have some sort of revolving door regulation, closing this revolving door, which created a lot of pressure for the remaining state to enact some sort of sweeping ethics reform. So between 2010 and 2013, 5 states caved in and enacted these changes. And this is important for us because we are going to argue that the enactment of this revolving door regulation changes the rapport between government official and underwriter during the negotiation that determine bond attributes and bond design. And this is going to be useful, as I'll show you in a second why this is going to be useful. So again, we focus, just to give you an idea, we focus on bonds between 2010 and 2013. These are small bonds. The median bond is $6 million, the average $20 million, maturing in 8 years. And for every time a bond is issued, is traded, we observe the trading price, we observe an identifier for the dealer intermediating the trade. We enrich this data set with information about the bond design and attributes of the issuing government. And we compile a data set of these revolving door regulation and how they changed over time. So the first thing that we want to do is to use this data to tell us what are the determinants and consequences of customization. And the idea is that, again, our argument is that by reducing in the context of this negotiation, the interest of the underwriter and the issuers, are likely not going to align. And in absent, absent this regulation, this employment opportunity may create conflict of interest and make the government official go along with what the underwriter wants. By eliminating this conflict of interest, this revolving door regulation affects the negotiation and therefore the customization of these bonds that are issued. And at the same time, we find that these regulations do not have a direct impact on the market for these bonds. And when I say customization, I should be clear, we always mean the number of special attributes that are included. So the first thing that we want to do is it true that revolving door regulation affect the bond design? And to check that, we regressed the number of special provision included in newly issued bonds on the enactment of these laws. And in particular, we distinguish between laws that target directly local officials, which are those actually involved in the process of issuing this bond, and those that target state officials. And if you see in all of these in this table is that, you know, the enactment of this revolving door regulation reduces the conflict of interest, and as an outcome, the bonds that are issued are much less customized. The number of these special attributes falls. And, you know, as we expect, if you compare, as an example, the first and the third column, the impact of this revolving door regulation is much stronger if they target directly the local officials, which are those actually involved, you know, in the issuance. So this is to say that, you know, it looks like revolving door do have an impact on special attributes, on bond design. And so can we use it as a trend? Well, as an instrument, there are the usual caveat. We have a lot of placebo, a lot of checks in the paper. The one that I really like is, you know, the one that's listed second here. So what we do, we look at the government, which is treated, right, for which the regulation changes, and we look at the credit rating for existing bond. And what we find is that that doesn't change, which suggests that, you know, the revolving door regulation doesn't directly affect the creditworthiness of the issuing government, but rather, yeah, the issuing government, which I think gives me a lot of peace of mind. So next, what we really want to do is to use this now as an instrument to check to first of all, measure and check the underwriter's incentive for over customization. And the idea is that the underwriter is not only active as an underwriter, but as I mentioned before, they also intermediate trade in the secondary market for this bond. So the question is, does customization help the underwriter when they are active as an intermediary? And to measure this value, we look at two things. We look at their market share in the secondary market for the bond, and then we look at the measure of gross profits, which is the difference between the price at which, you know, the total value that they sell of municipal bond in this secondary, you know, of a bond in this secondary market, minus, you know, the total value that they purchase. And so what we find here, we have OLS and SLS in the second, and you know, and IV estimates. And what we find is that by packing the bond with with a large number of these special attributes, the underwriter can increase their market share, and they can increase their, you know, the gross profit that they make only from, you know, intermediating trade in the secondary market for this bond. And in terms of magnitudes, it's going to be, so if increasing, you know, adding one, so going from 1 to 2 special provision per bond increases, you know, both market share and the profits by 1 standard deviation. So who cares in a sense? What are the implications? Well, next thing that we want to check is, you know, some level of search friction is natural, right? It's inherent in this decentralized market. And the question is, does customization make search harder for investors, hurt investors? And we measure that in 2 ways. First of all, we look at the intermediation spread. This is the difference between the price that an investor's the price at which dealers buy and sell bonds. This is basically a measure of the cost for the investor of participating in the market. This is the money that they would lose if they were to buy and immediately sell a bond. And then we look just at the trading volume. And so what we find is, again, using our IV regression, is that packing a large number of for these highly customized bonds, the intermediation spread is higher. So the cost of participating in this market, or the trading friction that investors face, is higher, and they trade less. So total volume of trade falls. Again, the magnitude is always, you know, 1 standard deviation. So yes, I think Eski has a question.
Yeah, so I'm trying to understand how you think about the welfare effects of customization. So I think you're telling us a story where customization is benefiting the issuer, but I'm having trouble thinking about whether customization is geared up for the investor. So
yeah, so that's possible. Oh, sorry, you haven't.
No. And,
okay,
and
yeah.
so would that affect the interpretation here?
So that's possible, and that's something we allow for in the result, in the estimation. So in the estimation, we allow investor valuation to completely depend flexibly on this customization. However, we find that they don't like it, and that's why we don't really push that aspect here. Speaking to this, we do find that the average trading price for bonds also falls, which is also consistent with this idea. Yes, and just let me clarify one thing. So we think that this customization, so that the underwriters, right? So we are thinking here about the underwriters, right? Over customizing, and the government, maybe liking, liking in part the flexibility. Okay. Okay. So basically, yeah. Sorry.
No, go on, Julie. I wanted to, expand on what you just said, Heskey. But all right, Heskey, my example a few minutes ago was the example that Julia had earlier provided, a call option that provided more flexibility for the issuer. You can imagine a put option where the investor, if some events happen, can put the bond to the municipality and require the municipality to refund at that point. So it could go both ways.
Right. So let me, sorry, can I just,
sure.
Should I go on? Okay. So
no, sorry, I wanted to ask, you show there's an effect on the spread, which is the gross margin. It goes up, the volume goes down. So I would have then asked the next question, which is, what about the product of the two? What's the elasticity of the underwriter revenue to the to an extra?
So that's what we show here, right? So it's not exactly, so that's exactly what we show here, where we have the basically.
So it's sort of positive, but not strongly so.
Yeah, it's very noisy, but it's positive, yeah. Okay, so basically this points to, sorry, I'm gonna start rushing. So this evidence points to two things. First, there is a distortion, or probably there is a distortion in the level of customization. And second, this hurts investors. And so we want to measure this underwriter's incentive to obfuscate and try to assess their welfare consequences. To do that, we are gonna design a model of bond trading, where the value of obfuscation comes from, and bond design, where customization is chosen. The market will be populated by three types of agents. You have government official, you have one underwriter, and then you have many dealers and investors who want to trade fractions of this bond. So customization or bond design happens at origination, where the underwriter and the official meet to bargain over the bond attributes, the level of customization S, the coupon rate, and the bond price. At the end of this negotiation, the underwriter buys the bond from the government and gives them the price, the agreed upon price. Then trading starts. So trading will happen in continuous time between, starts immediately after origination and then continues until maturity. And what happens here is that dealers, contact investors at a meeting rate that they decide. And when they meet an investor, they nash bargain together over price and quantities. So what are the preferences at origination? When the underwriter has to pay the price to the government, and then they buy the bond and they will trade it in, immediately at origination, and they will trade it until maturity, which gives them a utility, which I'll describe in a second. And then the government, they receive the money, which they can use to build their school. And then they are responsible for the payments associated with the bond, which means that they have to return the amount at maturity, and then they have to pay to make the interest payments. We're going to assume that the marginal cost of this payment is not one. And in fact, it may depend on bond attributes. The idea is that, the government can use these special attributes to move around payments and make sure that their timing coincide with moments where they have the most liquidity, which they may value. So also, because we want a role for these special attribute, for this revolving door regulation, we are going to assume that the government official actually may internalize in part the underwriter's payoff, and we are going to assume that we're going to introduce this parameter psi that measure the extent of the influence of the underwriter on the government official. So after that, there's trading. So we are going to assume that dealers and investors alike get some flow utility from owning the bond, where this linear term captures, as an example, the interest payments associated with the bond, and this quadratic term, the opportunity cost of owning municipal bond rather than, rather than treasuries, as an example. So why there is trade? Well, we are going to assume that this parameter nu is heterogeneous among investors, and it changes over time in response to a liquidity shock, which means which creates gains from trade, essentially. Again, speaking to what was asked before, we are going to assume that the distribution of these investors' valuation depends flexibly on complexity. Now, what happens how does trade work? So basically you have dealers that they choose a meeting rate lambda at which they want to meet investor, and they do so subject to search cost. There will be a base, and search cost basically depends on two factors. First, you have this base search cost, which again depends on complexity and depends on the bond attributes. And then we are going to allow for this network effect. The idea is what we want to capture, as I mentioned before, is a Rolodex model of search. So if you ask dealers in this market, the easiest way to sell a bond is contact one of your clients who bought the bond before, which means that as dealers increase the client network, it becomes easier to find dealers. And we capture that. Now we don't observe exactly their client network, and we proxy that with the number of their past trades. So in sum, what's the role of bond design and bond attributes? So it affects the investor's valuation. And as I was discussing before with Heskey, we are going to allow both for vertical differentiation. So everyone may hate, so these attributes may make the bond lower quality, or it may be amazing for a small set of investors. Then we are going to assume that it affects the level of search cost because the dealer has to, meet the investor and walk them to the bond attributes. And then it affects the network effects. The idea and what we want to capture here is that, it's harder. So and what this capture is the difficulty of explaining the special attributes to new investor, with the idea that let me keep it like that. And then we are going to also assume that it affects the cost of financing for the issue. So how are bond design determined? Through Nash bargaining. What does it mean? It means that the bond attributes and the coupon rate basically maximize the weighted, the total utility of the government and the underwriter, and the price F will split this difference. So basically, focusing on the choices of SNR, we have that they maximize the weighted sum of this utility. And looking at this, we can kind of think about what's the incentive to over customize. The idea is that when the underwriter is participating in this negotiation, well, they're choosing complexity, they're choosing customization, and this affect the value of investor, the search cost that other dealer face, and things like that. However, they do not fully internalize. And in fact, they may benefit from increasing search friction because that, increases the rent that they can get when they act as intermediaries. And they can also affect the network effects. And in particular, by affecting the network effect, they can, they may be able to increase, to make a competition from other dealers harder. So, we estimate the model. I'm not going to have a lot of time to describe it, but the idea is basically we have a lot of information from the trading market, from when this bond is traded, which we are going to use to get a sense of dealers and investor preferences as well as search cost. And then we are going to use this estimate and use them to isolate or to control for the underwriter's incentive and use the observed choice of bond attributes to recover the government's official preferences. So let me tell you the results. So first of all, we find that, so here we find that basically the underwriter, so the key result from this slide is that we find that the underwriter benefits substantial from the network effects. And if, in particular, if you look at, if you look at the average, and because of this network effect, in fact, the cost they pay to meet one investor for per year is $3,000. For the average dealer is almost 12,000. And so what's happening is that the underwriter has, at the beginning of the lifetime of the market, has this entire amount of the bond, and they sell it to investors. By doing that, they can quickly build a client network faster than any other dealers. And this gives them a competitive advantage in search, driven by these network effects, which they leverage to lower their search cost, increase their meeting rate. So what's the impact of this search cost of this customization on search cost? Well, we find that search cost affect two things. First of all, they affect the level of search cost. So here we have, the average search cost for highly customized bond. This is the 75th percentile, and the low cost, and a standardized bonds. And we plot it and we plot the search cost as a function of trading experience. So basically, if you look at 0, you have this base search cost, which is higher for these highly customized bonds. Because it's difficult to explain to an investor the bond for the first time. However, we find that the network effect are also much more pronounced for these highly customized bonds. And in fact, if you have a lot of trading experience, if you have a high trading network, it's almost cheaper, easier to find, the search costs are almost lower. And so why is this picture interesting? Because the average trading experience for an underwriter is 5, and the average trading experience, which is here, and the average trading experience for another dealer is 3. So what the underwriter is doing when they are packing the bond with these special attributes is lowering the search cost for themselves and increasing it for other dealers. So what about investor demand? Speaking to what Eski was asking, what we find is that the average investor does not like the special attributes. However, the standard deviation of investor valuation also increases, which means that, which is consistent with this idea that we make the bond niche products, right? So the average investor dislikes it, but there is a fatter tail of people who really love it. So the only thing I want to tell you about government cost is that it's convex in the number of special attributes. So in moderation, the government appreciates the flexibility afforded by the special attributes. However, the more the bond becomes complicated, the harder it is to manage. They have to hire a financial advisor, things like that. And so the cost skyrockets. So given all of this, let me, I have two counterfactual that I want to discuss. The first one is, can we get rid of this underwriter's incentive to over-customize? And to do that, I'm going to assume that basically the government unilaterally decides bond attributes, and then they negotiate the price and the meeting and the coupon rate with the underwriter. And so what happens in that case? Well, first of all, the number of special provision falls by 20%, which, is consistent with this idea that the underwriter really likes customization. What's the direct impact of that? Well, search friction decrease. So basically, if you look at the average dealer's cost, it falls by 3%. The meeting rate increases by 6%, the average meeting rate. So unsurprisingly, at this point, lower customization decreases increases liquidity. So who loses and who wins? Well, first of all, the government reduces the cost because they were issuing these very complicated bonds that are really hard to manage, and which was increasing their cost of issuing bonds. The investors are very happy because all of a sudden they get a better intermediation spread. They are able to sell and buy the bonds more frequently. Who are really hurt? Well, it turns out that dealers and that all financial intermediaries were really benefiting from the extra search friction in the market, because it's true, it increases their search frictions. the search cost, but at the same time, it also increases the margin that the spread that they can charge to investors when they need them. And it looks like the second effect dominates, and so reducing complexity hurts, all the financial intermediaries. Interestingly, it hurts the underwriter the most. Why? Because not only the underwriter like the search frictions, but they like the network effect, which were giving them a competitive edge against other financial intermediaries. So, should we just mandate standardization? Well, the answer is definitely not. I would say definitely not. I don't know, Karam is maybe one like my Stern recommendation, but and why is that the case? Because it's true on the one hand that standardization makes the trading market much more, liquid. The investors' welfare increases by 10%. But at the same time, the government really likes some leverage, some leeway in determining both attributes. And so forcing them to issue plain vanilla bonds, in fact, increases their search costs from borrowing. So bottom line, so let me conclude. So we provide empirical evidence that a market institution that suggests that the underwriter and government official rent-seeking behavior increases the prevalence of bonds with special attributes at the expense of taxpayers and investors. And then we use our model to highlight this incentive to this distortion and this trade-off between liquidity and flexibility. So I know it was a little bit rushed, so thank you for bearing with me. And that's it. Oh, thanks.
Yeah, thank you, Giulia. Amazing job fitting into the limited amount of time you have. And now we have Rob, who joined us and is going to provide some introductory remarks to the discussion. I think Rob wasn't here when I was thanking him for taking the job of the discussion, so I want to thank him again for accepting to discuss Giulia's paper.
Oh. My pleasure. Can you hear me now?
Yeah.
Yeah, that's okay. All right, great. Okay, and can you see that okay? Yep, good. Okay. So yeah, thank you very much to the organizers for inviting me to discuss this paper. It was a pleasure to read it and to think hard about it, which is par for the course for a paper by Giulia and Karam. Given all their great work. So let me jump into it. I was told I only have 5 minutes, so let me try to do 3 things really quickly. So Giulia did a great job clearly presenting the paper, so I'll only very quickly summarize it again to make sure we're all on the same page. Then I'll tell you why you should care about the paper, and I'll wrap up with a few comments and suggestions for the authors. Okay, so what does the paper do? It's going to study the design of municipal bonds. It's going to focus in particular on the role of underwriters. And it's going to note that for some bonds, underwriters are going to negotiate design of the bonds with the municipality. There's other competitive auctions. I'll come back to those. Other competitive sales that are run via auctions that I'll come back to a little bit later. But the focus here is on these negotiations, because in these negotiations, it turns out that underwriters might have incentive to collude with government officials to customize the bonds by adding special features or provisions. And this customization might benefit these underwriters because in addition to acting at origination, they're also active in the secondary market. And in the secondary market, they may have some advantages if search costs are increased. So if there's some obfuscation going on. So that's step 1. Step 2 is to provide descriptive evidence of the determinants and impact of customization. Customization is endogenous, and so they're going to quite cleverly leverage changes that made regulatory capture more difficult. So changes to these revolving door regulations that make it more difficult for employees to move from government to private sector or vice versa. So using that, they're able to establish that customization does indeed advantage underwriters. It harms investors, and it can have some impact on municipalities' costs. And then they move to this third stage where they're going to build and estimate a model of bond design and trading, and they're going to try to use this model to quantify these various impacts. And then importantly, what they're going to do in the model is they're going to allow the government official to internalize the underwriter profits. The model is going to spit out some estimates that they're then going to use to conduct policy counterfactuals, namely ones that impose standardization. And then their findings are going to be consistent with their empirical findings and suggest that standardization isn't necessarily the way to go here. Okay, so why should you care? Well, I care a lot. This paper combines two of my favorite topics, the study of financial markets and collusion. So in terms of financial markets, municipal bond markets are just really important with $4 trillion outstanding. What do these markets do? They provide governments with capital for important infrastructure projects. And so more papers studying municipal bond markets is appealing. And then they're going to point out that as has been demonstrated for other financial markets like annuities and certain mortgage products, there's been significant product proliferation. And in some markets, we don't care too much if there's product proliferation, but in the case of financial products, this leads to concerns about rising levels of complexity that investors, that savers are not going to understand all these different products. And so maybe there's some ulterior motive at play here that the designers of these products are actually benefiting in some way. And so this paper is providing some evidence of that. And all of this additional complexities leading to some push for standardization for many financial products. And this paper is going to provide some evidence that maybe standardization isn't always good overall from a welfare perspective, but it might have some benefits for investors. And then just in terms of collusion or conflict of interest, this too has been documented in a number of financial product markets. So conflict of interest have been documented in mortgage markets. Collusion has been documented in the LIBOR case, in foreign exchange markets. And in these cases, these frictions can drive up the cost of project, generate inefficiencies, and these are really important markets. So you should care about the paper. Okay, so just a few comments and suggestions. I guess I have 2 slides worth of comments and suggestions, but maybe just let me mention a couple here so that I don't, so I leave a few minutes for questions at the end. So the first, as I said, there's this other form of issue, and that is when bonds so when the right to run these bond sales is attributed via auction. And so my first suggestion is that the authors try to leverage data from those sales. They could do so in 2 ways. One, in the reduced form, it's possible they could compare the first stage results under negotiation to those under auction to see whether they're going to get the same kind of findings about regulations affecting customization. So using that basically as a benchmark, I think would be a nice idea. Second, they could use information from auctions to help design their counterfactual. So in their counterfactual, when they impose standardization, they're going to have just a single provision. And it seems like maybe they could look at what's taking place in these auctioned off underwritings to see what the competitive number of provisions is and use that as the benchmark for their counterfactual. The second point here is to provide some reduced form evidence or just slightly more clarity in general about the conflict of interest. So a lot of questions came up during the talk about what is the impact of these provisions on government costs. So in the reduced form work, they show that the number of negative ratings events falls under customization. There's a U-shaped impact on government costs in the model, but maybe there's some other features that they can highlight to show what's the impact. Overall, there's talk about conflict of interest, but it does seem intuitively as though municipalities should be able to negotiate better terms when underwriter profits increase. And so just a little bit more clarity about under what circumstances we think the government interests and the underwriter interests might not be aligned. And then this third point here is about the complexity score. So complexity seems to be treated sort of as a vertical component or as a quality component. More complexity is possibly bad for investors, but there's a horizontal component that's making it good for investors. And so I think just to think a little bit harder about how that plays into their search model is going to be important as well. So I think I should leave a couple of minutes here so I can talk offline with Giulia and Karam about some of these other points. And so let me just conclude by saying this. It's a great paper. There's careful investigation that nicely combines reduced form and structural analysis in order to study an important topic. And I'm looking forward to the next iteration. Giulia was rushing a little bit at the end, so she didn't mention that they have some other counterfactuals that seem very interesting that they're thinking of that I assume we'll see in the next iteration. So that's all I have. Thank you.
Thank you very much, Rob, for an excellent discussion. So now, Giulia, you have 2-3 minutes, and you can either respond to Rob's comments or try to let more comments from the audience come, or a combination of both. I mean, keep in mind that, I do want to close the recording session sharp, but then I'm happy to keep the room open for those who want to linger. So
why don't I gather other questions, and then I can discuss more with Rob, yeah. If there are any, otherwise I'm happy to.
I had a couple of things that were maybe related to what Rob said. So, I mean, the kind of variation across municipalities here is in terms of these regulations. I mean, it seems like New York City should be very different from whatever a small municipality in rural Iowa. Are there bonds very different? I mean, I didn't see that coming through, and I think this is related to this first bullet on Rob's slide of financial advisors. Like, how do I think about the sophistication of the municipality?
Yeah, so let me address that point, and I have 2 things that I want to say. So yes, so there is a lot of huge heterogeneity in this in what these municipalities are. We do, mostly thanks to Karam's like a very neat, data work. We can control for a large number of things: their revenues, their, what type of districts, what type of government they are, which we do. And we also in the estimate can allow for a large, for a very large heterogeneity to affect, the cost, the impact of this revolving door regulation, the cost of financing, the value of flexibility. But the thing that I want to say is that we do think, in fact, that, part of the story of what may be happening here is exactly that, these municipalities are duped by the government, by the underwriter. And in fact, we do find, as an example, so we do not control directly for whether the impact depend on whether you hire a financial intermediary or not, because that's endogenous. But so what we do, we control or we interact the impact of regulations with the concentration in the financial advisors market, with the idea that if the financial advisor market is very concentrated, you're going to have to pay more to hire a financial advisor. And so less firms will have a financial advisor. And we do find that in this market where the financial advisor market is very concentrated, the impact of the revolving door regulation is stronger. So we do think that, the fact that these the government officials are not very sophisticated is driving the impact is driving, at least in part, the collusion. And yeah.
So that's great. And I know that there's all sorts of confounds here, but just like some reduced form on size of municipality and complexity might be interesting, or size of the bond issue and complexity, or whatever it is, would be a little bit easier for me to parse, at least.
Yeah, so one thing, and so maybe this other thing may help as well. So one thing that we do also control for is the volatility of government revenues, and that really correlates with how complex these issued bonds are, with the idea that that's where you want to introduce contingencies, right? Like if you have very weird revenue structure, that's when you may need these special attributes.
So let me just formally wrap up the seminar so that I can stop the recording, but then whoever wants to stay, as long as Giulia has time, I'm happy to keep the room open. Before cutting the recording off and letting you go, I just want to remind you that we are here in 2 more weeks for another talk with Nicolas Schultz. So we hope to have you back. Thank you very much, and thank you again to Giulia, Rob, and Karam for being with us.
Yeah, thanks again, Rob.
Could I ask another question? And maybe this one is for Rob as well. There was a sort of suggestion that